ET Markets Global Summit, where Nikunj is in conversation with Saurabh Mukherjea. And
I think that mode of investing will serve us well, even over the next 2-3 years. If someone had to be more opportunistic and say, hey, I'm not just satisfied buying companies that give me 10x in 10 years and 100x in 20 years, I want to shoot the lights out. If you want to be more adventurous, then I think 2 or 3 themes worth looking at is, I think well-funded banks clearly will do well. I think the NBFC boom really is past us. Most of the NBFCs are well run, they'll pull through, but clearly there are, I would say, a good third of NBFCs who are in serious trouble, and I think will stay in trouble over the next couple of years. So well-funded banks, I think, will be a good theme to focus on. I think our pharma sector has been pounded beyond belief. I think there's a long overdue recovery that I think Indian pharma will go through. And the third theme, I think Vikas mentioned it, and I think will come back again and again, is I think Indian manufacturing, long in the shadows, Indian manufacturing will have a recovery as the RBI data is clearly showing that capacity utilization in the economy is hitting 75-80%. So our manufacturing sector, our capital goods sector, has a long overdue recovery ahead of us. But leaving the opportunistic themes aside, classically high quality investing has worked before, I think will work, especially as globally the cost of capital normalizes after an exceptional 10 years of super cheap money.
Navneet, I'll take the liberty of just quoting, some global market callers. We had an extraordinary pleasure of interacting with Ray Dalio a month ago on the channel. Then we had Howard Marks. The sense which I'm getting from some of these so-called global gurus is they are essentially indicating that the US economy is on a sugar rush and next year will be a tough year. There is no cynicism in the world, and after a 10-year bull run in the US market, the world should watch out for some mean reversion. Put that in context for us, what it means for Indian investors. Because when you hear some of the billionaire successful investors calling for not a red light but a yellow light, you just tend to ask yourself, am I missing on something?
So talked about Ray Dalio, I just like the 3 words that he says, pain plus reflection equal to progress. So just to reflect back and taking from where Saurabh left, last 10 years, if the genesis of global financial crisis was excessive leverage, that leverage has not gone anywhere. It just shifted from private balance sheet to the public balance sheet. The large central banks in the world have gone from $4 trillion of balance sheet to $15.5 trillion of balance sheet. And now, of course, that's getting unwound. So starting from US Fed and then ECB from December onwards, and some of the other central banks are likely to do that. Global debt as a percentage of GDP today is higher than where it was in 2007 and 8. And today the amount of debt which is required for $1 of additional growth is much higher than what it used to be 10, 20, 30 years ago. So we are definitely, for us to grow at the rate at which we have got used to from a global perspective, I think is going to be a lot more tougher and tougher. Now this whole money printing, historically, as the classic theory, should have led to inflation. It didn't lead to inflation in the goods and services, but it led to asset price inflation. And that's why the we have seen the asset prices inflated. He talked about right from cryptocurrency to real estate to stock prices. But it also contained volatility to a large extent because you had this unwritten put option from all of these central banks. That put option is now taken back, notwithstanding what Powell said yesterday or day before and markets have gone up. But I think we should be less and less reliant on what the central banks have done. They have been the only game in town. They won't be the only game in town going forward. And that's why, though you told Vikas at the beginning that don't use the word volatility, but I think that's the beast we have to learn to live with. I think what we saw in 2007, where we did not have a single month of drawdown in Indian equities, that was something exceptional. That wasn't the normal. We are getting to a more normalized market where we'll see probably a substantially higher volatility than what we saw in 2017. We have seen that in 18, but unlikely to change that in 19 as well. So, if the global economy, the global markets are going to see more volatility, I think we will also see. The heartening feature from India's perspective is, I think, the rise of the domestic savings coming into the equity market. And despite the volatility over the last 10 months, I think we are seeing a huge resilience among the retail investors, domestic investors, and you add that with the money that's coming from the pension funds.
Would you like to thank media once?
Sorry?
That we played a large role in keeping
Of course, and particularly Nikunj, you wanted your name.
No. I just wanted a graceful admission that media sometimes plays
on a very, we have been associated with you. On a very serious note, I think it's a joint effort by by the media and industry and advisors, I mean people who are sitting here. I think the awareness that has got created will keep us relatively in good stead if something goes really wrong with the rest of the world in terms of, I think if this domestic flow of like more than $1 billion in SIP, you add few $100 million from the EPFO and the pension funds, I think that will really help us. But otherwise, I agree with them that at the end of the day, you need the corporate profits to grow. Corporate profits actually have come down as percentage of GDP, which everybody talks about over the last several quarters. Corporate savings as a percentage of GDP have gone up in last few years actually, which means that there's good, I mean the amortization, depreciation as a percentage has gone up quite a bit. At some point in time, that money is likely to get spent. I mean, we have been in this huge deleveraging process that seems to be coming to an end. At some point in time, we are going to see a reversal in the corporate capex. So